In today's video, I am breaking down my favorite index funds here in Canada. So let's get down and let's check these out. So the first one is VCN. This is a Vanguard ETF up here in Canada on the Toronto Stock Exchange, and the MER is 0.05%. This means that for every $100 that you put in to this ETF, it's going to cost you about 5 cents per year. However, obviously the MER goes up when your investments go up because, let's say for example, next year, or at least let's say 2 months from now or whenever, it doubles to $200. Well, of course, now this is a 10-cent MER. It's based off of what you have in the ETF itself. It's currently at around $41 per share, and back with inception when it was made in 2013, it was at $25 per share. So it hasn't quite doubled in that 5-year range. However, that's still a very good return, especially considering the Canadian stock market was pretty well trading sideways for majority of that time. So basically it seeks to track, to the extent reasonably possible and before fees and expenses, the performance of the broad Canadian equity index that measures the investment return of large cap, mid cap, and small cap companies that are publicly traded on the TSX, the Canadian market. If you were to invest way back in July, for example, and this would be obviously a 1-year return with $10,000 would be currently worth just under $13,000. So not a bad return, but this is also going to be incorporating the dividends as well. So this fund has 180 stocks in its fund. That is absolutely huge. So you don't have any single stock risk. Even if Royal Bank, for example, tanks and the rest of the market doesn't, you don't have to worry. I really do like how Vanguard shows its market capitalization as well, mainly because you can actually see what the fund versus the benchmark is going to be. And when we start really looking down to the large as well as medium, small, and small cap companies, you can see that large cap companies take up 73% of the fund, while 13.5% are medium. I really do like how they break this down. It is quite interesting how there is 1.5% in other regions. However, North America, it's what we are looking to really cover here, it takes up 98.5%. I would actually assume that other just means cash, so I wouldn't really be all that worried. Again, 98.5% for Canada, 1.5% for other, and then United States 0. So I can feel confident saying that that 1.5% is just cash getting interest and really not doing anything until they need to pay somebody who sold their ETF, or obviously invest in new different investments. Obviously this is a Canadian ETF and it's a Canadian index ETF. Financials and energy are massive. Technology is only 11%. However, I would assume over the next 10 to 15 years that technology is going to be getting pretty close to that financials size. Now these are the top 10 holdings, and as we can see, just like we would expect, we would have Shopify, Royal Bank, and TD. Those are the 3 biggest companies in Canada right now. Enbridge is of course number 4. We have more banks as well, and then we also have railways, because railways are huge in Canada. They really ship a lot of the oil from the oil sands because of course for some reason the environmentalists think that pipelines are worse than railways, which confuses me, but whatever. And then of course Brookfield Asset Management, which is an asset management. Some people would put it into the financial space, but they're calling the sectors banks instead of financials, so that's why it's asset managers. And of course the 12-month yield, or the dividend that they do pay, is around 2.5%, and it is paid out quarterly. Next is XIC. It is an iShares ETF, and I really do like this one. This is actually my favorite out of all of them when it comes to just a baseline index of the Canadian market. Basically, why would you invest in XIC? It's because you would own the entire Canadian stock market. Over the past year, it's grown from about $26 up to just past $32, which is a pretty good return. It's basically what the stock market has been doing. That's exactly what this ETF is going to be imitating. This is what we get for the cash distributions over the past roughly couple of years. And what we do see is, of course, quarterly dividends. And I would really like to look at the year-over-year numbers, and I really like to compare Junes when it comes to these. And when it comes to June, it has been raised slightly, but not massively. We can also see the year-over-year numbers for totals, and we can see that for all cases, the dividend year-over-year has been raised each year, which is absolutely fantastic. This is what we want to see as dividend investors. It does hold 229 stocks. 229 companies, which is higher than the last ETF that only holds 180. For the distribution, it is 2.5%, which is the same as the last one. And of course, we do get to see that it is a quarterly dividend, and they do allow drips. For the fees, I do like the 0.06%. That's a very low fee, and I do like the risk indicator. However, at the same time, I really do not pay attention to these. I've seen someone saying that they were low risk, when in reality they were high risk in my opinion. So I don't really look at the risk indicator. I really look at the stocks that it holds. And as we can guess, we're going to see pretty much the same as the last ETF, Shopify, Royal Bank, TD being the top three. Brookfield Asset Management's actually a bit higher in this ETF and bigger percentage-wise than the last one. However, at the same time, we're going to be saying essentially the same companies in the top 10. I do like to see the exposure breakdowns as well, and of course, being Canada and being an index fund, we're going to see industrials, energy, and financials leading the pack, as well as information technology and materials. Those are kind of the top 5 sectors in Canada. However, you will be probably seeing the information technology probably jumping up like I was mentioning before. ZSP is a Canadian ETF. However, it is there to essentially copy and mimic the S&P 500. This is essentially supposed to be imitating SPY, but up here in Canada. The management fee is quite low at 0.09%. Market volume is also pretty good at 300,000 shares per day, and also quarterly dividends. Its annual yield is 1.18%, so it's not huge. It's not going to be like the Canadian index funds. However, the Americans, they do tend to not pay as big of dividends, mainly because they like to invest in their own company first so that they can grow their companies faster and bigger. However, the nice thing with ZSP is the fact that you can pretty much guarantee yourself what you're going to be getting every quarter. It's generally pretty similar. And the top companies in this ETF is Apple, Microsoft, Amazon. Those are the top 3 and pretty much the top 3 in the entire world. They are massive companies. Google takes up 2 spots, mainly because they have 2 different types of shares. They have Goog-L and Goog. Tesla is going to be most likely challenging the top spot over the next couple of years as well. And probably same as Nvidia because there's still that chip shortage. Also, with all of this artificial intelligence and future computer technology that needs to be continuously updated, Nvidia, AMD, even though AMD is not on this top 10 list, and Intel, which is not also on this top list either, is still great companies to invest in. How I like to really say to Canadians is, of course, if you're Canadian, obviously your first $10,000 to $15,000, if you want to basically have your money there in case of a rainy day, to invest in index funds. And I would say split it up 50-50 between something like a ZSP, for example, and a Canadian index as well. That way you can have exposure to both Canadian and American financial systems. You can get into both the stock markets. There's another version as well that you can get into with BMO, a BMO ETF like this one. I think it's ZSE or ZRE, something like that. I will try to remember that and put that kind of overlaid on this screen, and it's hedged to our dollar, so you don't have to worry about currency fluctuations. The ZSP chart was about $30 about 5 years ago and currently worth $61. So it's doubled in that 5-year span. Another option is to invest in a Dow Jones Industrial Average. This one is hedged to the Canadian dollar. This is ZDJ. And basically the idea is to again mirror and mimic the Dow Jones. This one's distribution is going to be a bit higher at 1.5% for the dividend. The MER is 0.26%, so it's a bit higher. Distribution is quarterly, and also its market volume is 23,000 shares per day, so it's not huge by any means. Again, even distributions, you're not going to be guessing what you're going to be getting into the future. It's pretty well set, which is nice. I like that when BMO shares or ETFs do that. And the top 10 companies in this ETF is United Health, Goldman Sachs, Home Depot, Microsoft, Salesforce, McDonald's, Visa, Honeywell, Amgen, and Boeing. The only one I really would worry about is Boeing, but I really think they are starting to turn it around. And we can see also from here that, of course, it was around $30. It's pretty well doubled since then. This would have been a fantastic time during the crisis to buy into this ETF, or really anything, because of course everything has gone up. Whenever this happens, it doesn't matter what you invest in, you're always going to make a smart and good decision because it's the whole market going up. And the ticker for this one was ZDJ, and it's absolutely amazing in my opinion. This next one is ZQQ. It's basically going to copy the NASDAQ 100, and this one is also hedged. What does hedged really mean? Well, in simplistic terms, basically it means that they can play money games with the currency market so that now you don't have to worry about, let's say, the currency being devalued by 10%, but your stocks are valued 10% higher, which means that you don't make any money. You don't have to worry about that. It's hedged, which means that you don't have to worry about the currency fluctuation. However, at the same time, that could be a negative. And I'm really going to break that down really quickly, which is, and I should do a really good in-depth video about this, but why is it important to really watch for hedged ETFs? Well, for one, you can really watch out for hedged ETFs because, of course, it can save you a lot of money when there's a lot of fluctuations in the currency. However, if your stocks are going higher and your currency is going lower, that can also help you in terms of, and I mean currency, the currency that the stocks are in. So let's say the US dollar is going higher, and of course your Canadian dollar is going lower. Hedged wouldn't be necessarily all that bad, but at the same time, you could also gain even more if the dollar of the US, let's say, is going lower or higher. The US dollar is going higher and your stocks are going higher and your Canadian dollar is going lower. You could get a 10% push by the currency, a 10% push by the stocks, and now you're getting a massive push while your currency is devaluating. So there is a point to having both. Sometimes the hedge will not always be the best choice. But basically a NASDAQ ZQQ index ETF is going to be really mirroring the NASDAQ. And the NASDAQ stock market is mostly tech. Its average yield, or at least its current yield, is 0.3%. Tech companies don't generally pay that much of a dividend, if a dividend at all. The expense ratio is higher at 0.39%, and the market volume is at 52,000 shares per day. However, the dividend is only going to be annually, it's not quarterly or monthly. All of its top holdings are going to be tech: Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Nvidia, PayPal, and Adobe. And we can see that it's gone from about $38, $35-ish all the way up to $109 to $110. That is over a 3x return since 5 years ago, so obviously this is going to give you higher growth, hopefully, into the future. Remember, whatever happens in the past isn't necessarily going to happen in the future. And again, once per year dividends, and they generally, not always, but generally go up year over year. I hope that this video has helped you with your investments. If it has, hit that like button, subscribe. Let me know down in the description your favorite out of this list. I'll see you guys again next time.